Hi, this is Michael, Neuenschwander with Outlook Wealth Advisors. I'm a CPA as well as certified financial planner. Thanks for joining us today. And today we're going to tackle sort of a version of a pretty common question we get. So the question is, well, if I'm 64, I've got 800,000 saved for retirement, and we want to be able to retire, or can we retire and spend, 6,000 a month plus, 15,000 budgeted for, travel, some extra fun in there. So let's sort of unwrap, that question a little bit. So in this case, it's a couple, both 64. So they plan to retire at 65, so about a year away from retirement. They've saved 800,000, so a pretty good amount. Of that, like many people, 700,000 of that is in their IRA. In their retirement accounts, they got about 100,000 in brokerage in the bank account. Now, one of the big questions when we deal with these kind of questions of, well, can I retire? They've done some of the heavy lifting because it's never a question of how much have you saved. It's always the question of, well, how much of it do you want to spend? So in their case, that's 6,000 a month, so 72,000 a year, but plus taxes, so we got to add that to it. And they want to be able to travel and have 15,000 a year towards some extra fun. Now, in that also lies another question. So we're assuming in this scenario, as we'll show, that 15,000 a year, that's for the first, 10 or so years of retirement. It's not a permanent expense that's there forever. So when we add that up, 72,000, so 6,000 a month for 12 months, plus 15,000 of expenses, so we're at basically 87,000, plus some taxes. So we can't forget about good old IRS within there as well. So in that tax bracket, they're going to have about another 8,000 of taxes that's due also. So the real number we're working with is they need to have spendable money, if you will, of approximately $93,000. And so they've got 800,000 saved up, but to go with that, they also have Social Security. Now, we said they're 64 now, so their plan is if they retire at 65, so just over a year, go ahead and take Social Security. Now, we've done prior videos, and we can dig into this a little bit more as well, but if they take Social Security at 65, they are actually going to be taking a reduced amount. And so that reduced amount of Social Security was going to end up being $3,400 for him. She was going to collect on a spousal benefit, so about $1,700 for her. So about $5,100, combined. So that's their source of income, no pensions, no other income like that coming in. So right off the bat, one of the first things we begin to do is there's a few assumptions we have to make. First is going to be, well, what about inflation? Because we need that 6,000 a month to account for taxes and account for inflation over time. Now, for now, we're going to use 3% inflation. I know the last couple of years have been higher. Officially, the government would say inflation over the last 30 years has been, a little above 2%. In my opinion, the government doesn't capture the total picture of inflation. The other thing we'll take into account, though, is there's also going to be medical expense. So if you're in a situation like this and kind of wondering this kind of question, well, the way Medicare works in retirement, it actually comes out of your Social Security check before you ever get it. And the approximate cost for Medicare today, for a couple, it runs roughly $175 a month for Medicare Part B. And then if you need a prescription plan, call it another $50 to $75. And then there's a whole choice between, do you do a Medicare Advantage or do you do a Medicare Supplement? But a Medicare Supplement probably runs roughly another $175. So for a couple, you're into your medical expense about $750, $800 a month before you've actually had any real medical expense. So right off the bat, if that's something you've not taken into account for your own retirement planning, maybe factor in that number of about $800 a month still needs to go towards medical coverage and medical insurance. For now, we're going to assume that that $6,000 a month that they want covers the medical as well. So now if we look at that scenario, it says, well, they'll have Social Security coming in. Now, we've touched on Social Security before, but I'll share with you, in our planning, Social Security doesn't really keep up with inflation. Because as we said, they're going to take that Medicare premium out of Social Security before you ever see it. And a good rule of thumb is if they give a raise on Social Security, they are also raising the cost of Medicare. So our assumption for how much does Social Security increase over time, we're simply using 1% as the net increase, on Social Security. So that's the framework we're going to run under. And the first thing we start is with what we call simply a retirement cash flow. And that's beginning to put these big pictures in place. Here you can see they have 800,000 saved in retirement. They're going to have approximately that 5,100 a month for Social Security coming in, lined up against roughly the gross income that they need of that 93,000. So ultimately that leaves them needing to take out, approximately, call it another 40,000 or so out of their 800. So right off the bat, there's one of the first things we can check. 40,000 of 800 is about 5%. Now, many of you may be familiar, you've heard of this retirement rule called the 4% rule. It says, so long as you don't take more than 4%, well then supposedly you should be okay in retirement. So as it stands right now, they're pushing right up against, that scenario. But as we carry that forward, there's a few other things we take into account. We indicated they could take Social Security right at 65 when they retire. They could hold off a little bit longer. In this case, holding off at least until full retirement age bumps their Social Security another several hundred, per month. So in their case, that's actually a better strategy than starting it right away. So instead of that 5,100 combined, we're getting much closer to almost 5,700 between the two of them by waiting that one extra year. So we put that into a retirement scenario, and this first picture, that retirement cash flow, is just a simple snapshot to say, are we on the right track or not? The next thing that comes into play is another tool called a Monte Carlo scenario, and quite simply, I'll keep it real simple, that's simply a way of saying, let's take this retirement cash flow and have the computer run 1,000 different versions of it. Because the other big assumption we make in this, what is the rate of return? Meaning, how is the portfolio invested? What's reasonable in both good years and bad years? We tend to run things on a more conservative basis, meaning we'd like to assume a rate of return of 5 or 6%. Somebody could assume they earn double digits for the rest of their life, but the reality is that's not how the market works. Even at 5 or 6%, we know the market doesn't give us a nice steady 5 or 6% every year. Some years are good, some years are bad. But by running it conservative and then running a Monte Carlo scenario, it allows us to test how often does that work. Even when we account for those bad years, what's the likelihood that this plan works? And in this case, adjusting for those scenarios, that plan worked about 90% of the time, assuming they waited on Social Security and assuming that 15,000 going towards that extra spending in retirement was truly temporary. If they increased their expenses and said that extra 15,000 was going to last their entire lifetime out till age 90, it drops the likelihood of their plan working from in the 90s all the way down to in the 70s. And so that's pretty scary considering that's only one change, in their plan. But in general, when we see plans that have a likelihood of working of 80+% of the time, that usually means that's a pretty good plan that can weather the storm. But there's a few other considerations we have to take into account. Taxes is a big one. Right now, we looked at the taxes based on what they wanted to spend, but we know taxes are going to change. What it's looking like based on today's current tax laws, taxes are going up in a couple of years. But obviously, with every election, every change in Congress, taxes can change again. And so historically, we're at pretty low tax rates. So should there be some extra tax strategy that goes in there in terms of ways to reduce taxes in the future? The other part that comes into play too, heaven forbid, what if one of them passes away? And unfortunately, it's the fact of life. It's not a question of if, it's a question of when. But when that happens, one of the Social Security checks goes away. Typically, some of the expenses go away as well, but they certainly don't get cut in half. Realistically, the expenses are typically still 70 to 80% of what they were as a couple, even for a single person. And as we've experienced, what about some of the other things in life? What if inflation spikes back up? What if we have an extended downturn in the market? And one other scenario, unpleasant, but it's also the fact of life. What happens if there's a big need for long-term care, down the road? And in today's dollars, long-term care may run anywhere from an extra $4,000 a month for assisted living, all the way up to close to $8,000 to $9,000 a month for true nursing or memory care kind of service. So as we look at a retirement cash flow, it's not simply a question of do you have enough to make it to 85 or 90? Do you actually have enough in reserve to address those long-term care needs or other things that may come up? Or have you addressed a part of the plan to say, well, we've either budgeted for long-term care insurance, we've built in some long-term care protection through some of our other investments. So when we talk about the idea of can you retire at age 64 with $800,000 and spend $6,000 a month? On the surface, the answer says it may look pretty good if you've addressed those other areas we've touched on. Having the proper plan for Social Security, addressing taxes, addressing long-term care, and also addressing the investment risk. Making sure that while you have a portfolio that's designed to get the rate of return you need in the long run, you're not taking so much risk that when we have those bad markets that may drop by 20 or 30%, unfortunately, in retirement, it's pretty difficult to recover from a minus 20 or 30% because you still need money the next year. And those are the kind of things that even if you have a plan that on the surface works, you have to stress test your plan, stress test this retirement cash flow to make sure it can weather not just the good times, but the bad times as well. So today we've addressed, can a couple age 64 with $800,000 retire and be okay while spending $6,000 a month, and as well as having $15,000 a year towards some extra travel and fun? If you have a question like this, or this was beneficial to you and want to continue to get more information and topics that are important to retirees like this one, or things like planning for Social Security, or Roth conversions and what the thoughts that need to go into that, make sure you hit subscribe and follow us in the future. Hopefully this is a great benefit for you. If you have specific questions or want to talk about your particular situation, please don't hesitate to also reach out. Look forward to visiting with you. Thanks for joining us on today's video.